Hello friends, welcome to this video tutorial on mutual fund investment. In India, today mutual fund industry itself manages more than 13 lakh crore of assets. There are more than 40 asset management companies which are managing over 10,000 mutual fund schemes. Hence, we want to make a video on mutual fund investment for beginners like you who can really reap the benefit by investing in mutual fund schemes. In this video, you will be able to learn what is mutual fund and how it operates. We explain you the complete benefits of mutual funds, and we will also look into a case study on SIP versus lump sum investment. What we don't do is we don't advise you to buy any schemes, and we are not a rating agency, hence we don't rate any funds too. But what we really do is to make you understand the concept of mutual fund in a constructive manner that can help you to make the investment decision prudently. Now let us understand the basic definition of mutual fund. What is mutual fund? Mutual fund is an investment tool where money has been collected from large pool of investors for the purpose of investing in equities, bonds, etc. Suppose you have group of people who are different in characters wanted to participate in the investment market. Since they don't find time, they are depending on a mutual fund house to operate their money. Hence, money has been collected from these group of investors, which is otherwise known as pooling of money, which we have seen in the first level of discussion. This mutual fund is managed by professionals who are known to be portfolio manager, fund manager, and so on and so forth. The money which is being collectively distributed by the investors will be forwarded to the fund manager, who is the professional obliged to operate this fund. This fund manager is a representative of a fund house, which is otherwise known as an asset management company. Fund manager allocates the investors' money into various stocks and bonds based on the research and his recommendation. Let us see the benefits of investing in mutual fund. Mutual fund being an investment tool that allows the investor to seek some of the common benefits out of its investment. Those are safety, where mutual fund is providing the safety in form of diversification, which allows the investor to participate in the investment market by distributing its resources across various asset class and various stocks. It provides suitability in form of fund categories, where the investor can choose the open-ended scheme or closed-ended scheme depending upon his requirement. It provides flexibility, where mutual fund is not only common for HNI investors, it is quite possible for retail investors who can start saving in mutual fund in form of SIP. It provides liquidity by producing dividends out of the mutual fund scheme. As you all know, the most important benefit of investing in mutual fund is diversification. Let me ask you a simple question. Suppose you have group of eggs which needs to be kept safe in a basket. What do? Either you will be allocating all the eggs in one basket, which may cause some damages, or you will allocate the eggs appropriately in different baskets to keep it safe. Of course, it is option B, where you want to allocate the eggs appropriately in different basket, hence not losing any of the eggs to be broken. Same thing you need to apply with respect to mutual fund investing, because it provides the diversification benefits, where the fund manager will invest the money into various stocks in different sectors to reap the benefit out of every stock rather than increasing the concentration risk by allocating all the money in one stock. Now let us understand the various fund categories with mutual fund. The broad categories are equity fund, debt fund, hybrid fund and thematic fund. Equity fund is otherwise a diversified fund where most of its allocation goes into equity. The real lifetime example would be HDFC Top 200 fund. The second category is debt fund, where most of its allocation goes towards money market instruments like fixed income securities, treasury bills, government securities and so on and so forth. The real lifetime example for debt fund is ICICI Pru Savings Fund. The third category of fund is thematic fund, which is otherwise known as sectoral fund, where the money will be invested into one particular sector which carries a single theme on the whole process. The real lifetime example would be Reliance Banking Fund, where the most of the money is invested into banking stocks. The last and fourth option category of fund is hybrid fund, which is otherwise known as a balanced fund, where the money will be invested into equity and debt proportionate, which will be reviewed periodically by the fund manager. The real lifetime example for hybrid fund is Tata Balanced Fund. After understanding the various categories of fund, it is the decision of the investor who is going to choose which fund to invest at what time. Mutual funds are also classified as open-ended schemes and closed-ended schemes. Now let us see what is an open-ended scheme and what is a closed-ended scheme. Open-ended scheme always provides an exit door to the investor, which doesn't carry any lock-in period. It comes with a minimum exit load to the investor. It provides a lot of redemption pressure to the fund management side. On the other side, the closed-ended scheme comes with a minimum lock-in period. The real lifetime example is fixed maturity plan. There is absolutely nil redemption pressure on the fund management side because it provides sufficient time for the fund manager to prove his strength. Mutual funds also comes with two different options. One is growth option, other one is dividend option. Growth option is otherwise known as capital appreciation, where the money will be invested into the growth fund. Whenever the appreciation happens, it gets reinvested in the fund itself. On the other side, dividend option is something like profit booking, where the fund manager will book the profit then and there and pass the benefit to the investor at periodic interval. How to become an eligible mutual fund investor? Of course, you need to have a good amount of money to become an eligible investor. But apart from that, the regulatory body demands some sort of KYC compliance needs to be completed before investing into mutual fund. The basic requirement for completing the KYC is a permanent account number, which is formally known as PAN. You need to have a legible photograph of yours and a valid address proof, which needs to be submitted along with the KYC application form to your brokers, agents or asset management companies as well. After completing the KYC, you are always open to invest in mutual funds in any form, let it be a lump sum investment or an SIP. I hope you found this video more useful. To watch out the video on SIP versus lump sum mutual fund investment, stay connected and subscribe to our YouTube channel. Thank you.